What's going on, everyone? My name is Nicholas Merton here from Detached, and today is March 8th of 2023. Well, folks, I hope you are having a fantastic day wherever you are, because in today's video, I gotta go on a bit of a rant and rave here. Today, I need to spend some time to talk to you guys about the disparity, the huge difference between the narrative that perma bulls are pushing for Bitcoin, for stocks, for the risk-on tech plays, and every other type of asset out there that have been based on the narrative of the last decade that the Fed can come to the rescue versus the reality, the harsh reality that we are stepping towards a recession and that we are stepping towards a much tighter monetary policy environment than so many previously thought. And I'm going to be talking about how this is going to deeply affect Bitcoin and other risk-on altcoins, as well as the broader asset market as a whole. If you guys like this video, the best way you can show your support is by dropping a like. It's going to be a difficult video, but I got to speak to you guys on this. This is one where I'm going to get really down to the nitty-gritty here. So I don't want to spend time doing any TA on Bitcoin. We've talked a little bit about maybe a potential for some kind of deviation here up above the channel. Either way, we've been on the narrative that this is a relief rally. And I'm going to go ahead and say that one macro event from yesterday has pretty much tossed even that out of the window, and likely is going to lead us towards rolling down here very soon. And what is that event? Well, it was the recent testimonies from Chairman Jerome Powell from the Federal Reserve in front of Congress, where he was answering questions from Republicans and Democrats and essentially was trying to address why the Fed has taken the stance it's done on monetary policy. Now, I'm going to go ahead and say one quick thing here, which is that as we've talked about for the past month and a half, the Federal Reserve is likely utilizing this kind of flip-flop narrative mechanism that the Fed is commonly known for the greater part of its history, where it says one thing and does another to its advantage in order to create liquidity traps, to absorb liquidity, or more specifically, to have an excuse to add in liquidity to the system and keep towards its 2% inflation target. It has done this for the greater part of the last decade. The only difference this time around is that it's utilizing the euphoria and continued optimism as a way to trap liquidity and absorb liquidity from the real economy into financial markets by getting people trapped in long trades to the upside, which then therefore move lower, where they sell it towards other investors in the market, where that liquidity is absorbed. That is what we wrote about in the Dash report back in the prior month, and it's continued to play out here as we're starting to see lower highs and lower lows. We are not seeing a continuation of that upward trend. Well, anyways, I want to go back to this topic point here, because the big thing that was revealed yesterday is exactly what we've been talking about for the past couple months. We didn't get everything right in 2022 or in 2021, but we certainly have gotten right since back in August that the Fed is not done with its job, that it has to continue tightening rates. The inflation numbers we got back in the prior reading for the PCE or the CPI signaled that the biggest inflation jump since the summer, month over month. And at an annualized rate, if that continues, we'd still be at 6% annualized inflation, signaling that the Fed has not done its job. And Jerome Powell made it clear yesterday that he is going to continue hiking the federal funds rate, that other central banks in the world are likely going to continue doing the same exact thing, and that the job of taking down inflation to its 2% target is well beyond where it needs to be. We are still at heightened annualized inflation. And equities, of course, did not respond positively to this. Not only did we have a prior down day for most indices, but yesterday we saw a 1.25% drop in the NASDAQ. We saw for the S&P 500 a 1.5% drop. And even worse, this is the really telling sign here, the defensive stocks, the stocks that should be protecting your portfolio, that have cash-rich income and pay dividends. The Dow Jones, the 30 largest companies, dropped 1.7% yesterday. We are no longer testing up towards the same ranges we saw in the prior months on these defensive plays. We are no longer seeing the S&P 500 setting in higher lows and higher highs like it's been doing since back in September. And we are certainly not seeing the technology stocks being able to find support on the 200-day. They are going in the midst of the 200-day and 200-week, signaling that this is likely a deviation. As we've talked about time and time again, a short-term window of time that tricks investors into thinking that it's the kickoff of the next bull market. Well, price action is clearly showing that it's the latter. It is a deviation. It is a trap. And as we talked about the other day, the VIX was entering into the pocket it has been holding for over 5+ years. You do not want to bet against the VIX here, which signals that volatility is relatively low in the grand scheme of things and that it's ready to start expecting some volatility in the market, especially with how long we have been chopping in this support range here, which likely means we're building up for something big. Now, if you guys don't believe me on this, I want to go ahead and observe one of the biggest recessionary indicators, one of the key indicators that shows us that the Fed has a lot more to do than what it's already done and that it's going to cause insurmountable, unavoidable damage. I'm not blaming Jerome Powell here for this. I'm not blaming the Federal Reserve. It's the necessary steps they're going to need to take. The only thing I would say is that they could have done it a lot earlier and would have had to have caused less damage in the economy, given people less false hope, and unfortunately are now going to have to do even more as they play catch up to get ahead of inflation. Something we've talked about. The Fed has not been ahead of inflation. It was getting there with the 75 basis point hikes each and every meeting. But now they have fallen behind the curve. We need to look no further than the yield curve inversion between the 10-year yield and the 2-year yield. Ideally, long-term government treasury notes or government debt from the United States should be paying a higher yield for long-term bonds versus that of short-term bonds. Unfortunately, we see a common pattern during early stage signs or the lead up into recessions, not during them, but before, a couple months to a year before, we tend to find that there's a continuous trend where the 10-year yield is paying a lower yield than the 2-year yield. Or more specifically, that the 2-year yield is continuing to expand higher due to an expectation of a higher federal funds rate in the short term than the 10-year yield. And you guys see, as we have here on the chart, we have inverted the yields. We've actually been talking about this for months. And in fact, this red dot here we had was already signaling panic signs and the fact that we have dropped to one of the highest inversions to the downside we've seen in our history. But now, here in the month of March, just 8 days in, we've already dropped another 18%, as you can see in the top left-hand corner. We're down from 0.9% to the negative side, down to -1%. A 1% spread from what you're going to earn on a 2-year Treasury note versus what you're going to earn on a 10-year Treasury note. This is absolutely gobsmacking. If you guys want to know why I'm so heated up here, we're usually very level-headed here in the channel, but I need to send the alarm bells here. I need to make it very clear to you guys. We are entering into uncharted territory here. And the reason for this is because the markets, the financial system, is at such a disconnect. The S&P 500 is only down from its all-time highs. If we go from the highs that were back in January to where we are now, we are only down 17% here. For the NASDAQ, if we take it from the top to bottom, while it has corrected a bit more than the other indices, about 30%, this is not enough. The Dow Jones is the worst here, right? The defensive stocks are only down about 11%, even considering the slight decline back from February. Only 11% down for the broad defensive plays. Yet we are having the biggest yield curve inversion, the most consistent indicator for predicting recessions, where in those recessions we usually see equities drop 30 to 50% or more, depending on which index you're talking about and which category of risk on or defensive stocks you're discussing. Now, I want to go ahead and, again, emphasize here that the 2-year yield, which we've been talking about on the channel, has just continued to expand week by week by week by week. While equity markets, back during the Fed's January meeting, took into play that, the Fed's just bluffing. They can't raise rates. They're just trying to spook markets. Well, the bond market has been properly increasing the 2-year yield because they knew what the Fed was actually saying. The Fed is saying whether or not they like it or not, they have to continue cooling inflation. And when you look at the PCE number and you look at the CPI numbers, already of which we know are cooked to some degree. Let's just go ahead and put it out there. Even the bulls were saying back a couple months ago that, the Fed's just going to cook the numbers. They're going to lower the inflation number. They can't continue to tighten. Remember that narrative that was championed back a month or two ago by so many content creators, by so many influencers out there in the market? Well, pie in the face, it's not happening. There is no way you can cook the numbers on inflation. Inflation itself is a monetary phenomenon. And we have injected way too much easy money in the system, not only over the last decade, which is starting to manifest in the economy, but more specifically in the overt liquidity surge we had during the pandemic. And that is a problem we are going to have to face. And again, if you guys don't believe me here, that's totally fine. But just take a look here at the metrics. For next month's meeting, take a look at the probability for the CME Fed rate monitor tool, right? This is, again, some of the biggest prediction markets here going on and estimating what the Fed is going to do next. Back just a couple weeks ago, about a month ago in February, the probability for a 25 basis point hike was 97%. That has now dropped to 28%. Now we're seeing instead that a 50 basis point hike, or at a minimum, some general increase of a much greater magnitude, practically double of what we were expecting before, has gone from around a 0.4% probability all the way up to a 71% probability rate. And it's not just next month's meeting. Let's take a look at the preceding months and the continued expectations of a higher Fed rate hike, right? Some of these ones, like for example, in May, which will be the next meeting after the March one, as there's usually these 2-month intervals or sometimes a month and a half, we can see that a probability of a 5.5% to 5.75% target rate probability went from about 0.2% back in January all the way up to 20%. Some of these pie in the sky kind of numbers that people just didn't expect could happen are now really starting to come into question as the Fed made it very clear. Jerome Powell said in this recent testimony to Congress that they could be expanding rates at a much higher rate than previously expected, and that target federal funds rate is going to be going higher. I know this can be boring, guys, sometimes wondering about what the Fed is going to do, but we've been talking about this for months. We've said that we are at least coming into this 5% range way back when we started to flip bearish back in August. The Fed is going to have to continue this rate hike aggression that it's been showcasing since back in 2022. However, I got to tell you guys something. I'm going to be completely blunt here. I know I've been saying a lot in this video, and I don't mean to come across as egotistical, but I know a lot of this video I've been saying we got something right, we've been talking about this. I got to be honest with you guys, we were wrong on one thing here, and that's that we weren't bearish enough on the Fed's rate hikes. We should have expected a higher target rate, because I should have priced in that the Federal Reserve would have a month or two where it says, oh, we're just going to do 25 basis point hikes. We're going to feel it out, see how it goes, without making sure they had the job done. And I understand that there is maybe some strategy here that the Fed is utilizing these relief rallies to absorb liquidity. It is one of the mechanisms that we talked about, like I said, in last month's edition of the Dash Report. But I gotta tell you guys, the better thing here would just be to do 100 basis point hikes 2 or 3 times in a row, crater, have a short-term sharp correction in equities. Really set the tone that the Fed is here to cool inflation first, and then have the job done. Reduce the balance sheet by $200, $300 billion from one FOMC meeting to the other. And perhaps from there, we would be at a point where it would set the tone, it would cool the excess consumer demand right now that is coming through the form of credit cards, auto loans, mortgages, all of those different forms of credit. It would slow that down and would have got the job done. Unfortunately, the Fed did not do that. They have continued to start to cater to equity markets and assets. And well, that's going to lead them having to raise the rates even higher. Our new target rate here, which is this is the first time you guys are hearing this here on the channel, basically we're expecting that this is going to get up somewhere around 7.5%. It's going to be the highest federal funds rate that we have seen in order to get inflation on the biggest rate increase to the highest point we've seen since 1990. That's at least our temporary target here. And why is that the case? Well, because the prediction markets are already signaling that momentum that the Fed is going to have to head higher, for one. But second off, I think it's at the point now where the kind of Paul Volcker rule here is going to come into play, where inflation, right, which is already still sitting at the 6 to 7% range at the moment, the federal funds rate is going to have to get above that. Right? Now, again, some people disagree with this. There isn't a ton of economic research on this, but I think it's a phenomenal goalpost to go for here because there's not much else that the Fed can do at the end of the day. And people who are saying that it's supply chain issues, that this and that are causing inflation, look, I'm not saying that's not a part of it on the supply side, but this is a monetary phenomena. The core part of why inflation is so high is because at the end of the day, we doubled the monetary supply. Already after a decade of expansion since 2008 into 2018, we already took the base money supply from around $1 trillion all the way up to 4.5 trillion. And to make matters worse, we expanded it even more rapidly during a 2-year window, all the way up to $9 trillion. You guys may remember on this chart, we have not adjusted this TA at all. We had 3 different projections here. Either the Fed would cut out the secondary wave of the COVID expansion from 2020 to 2022 down to about 7 trillion, which I thought was, again, a reasonable target. It could come down here into the mid-range here, cutting about half of that balance sheet expansion or all of that COVID stimulus, which I think is an improbable scenario. I think we're going to be somewhere in here between these two, which is taking us down another $2 trillion in the base money supply. And you guys don't think that that's going to have a ramification on equities or crypto, that Bitcoin is somehow going to have a bull market when there's a $2 to $1 trillion liquidity contraction in the base money supply, not to mention all the credit that's been built on top of that is going to contract. It is going to be a brutal awakening, folks. And I'm not even here just to tell you guys to not buy the dip, or to not, just have some cash on the sidelines for buying up assets when they're at a discount. I'm here to be real with you all in that I would be saving some money. Dollars are becoming more scarce in the economy. You can earn a great interest rate right now, either by holding bonds and getting a great yield or just having money in your bank account. Finally, we're getting some real yield on your savings. And on top of that asset markets, if even the defensive plays are dropping like this on news from the Fed, and we've seen multiple relief rallies in this bear market, if we are not done, no dividend from a stock is going to protect you from the principal loss you're going to have from when you bought it and when you're unfortunately going to have to sell it. Crypto is not some completely separate market. We can see that very clearly. If you just simply take a look at the Bitcoin to NASDAQ ratio, which we talked about the other day, it's been declining since back in February. And it shows very clearly the gravity of what the Fed is doing right now is going to continue having a weighing effect on Bitcoin's price. The past month and a half has been full enough proof that crypto is not separate from everything just yet. And maybe Bitcoin doesn't go all the way down to, 7K or 10K, some kind of large, absurd decline, which is generally in line with the traditional crypto bear markets for one, right? But maybe it's still going to just go to 14K or 13K. I'll happily wait for that. I'll happily wait to buy into capitulation rather than buying into a FOMO relief rally that is typical time and time again during bear markets. Anyways, guys, I've rambled on a good amount here. I'm just here to say that if you are in the high-risk plays, the high beta plays, like ARK, right, the technology stocks like Roku and all these names that grew enormously during the pandemic, I think it's time to reevaluate and consider that these can go down much further. If you are in the high beta plays like Tesla, well, I like Elon. I have nothing against Cathie Wood. Some of these people are really great individuals who focus on innovation, who have built great companies and products. However, if you are exposed to these plays, if you are buying into the FOMO, especially at these heightened levels, I would say make sure you've got some capital on the sidelines to pay for your mortgage. Make sure you've paid down your debts. Make sure you're protected. I'm not here to tell you guys what to do. I'm just letting you know that if I were in that position, if I had debts or obligations, or I didn't have some cash in the bank, I would be making sure to do so now. Just my take personally. You guys have to determine that for yourself. And I know so many of you out there, I'm not here to speak down towards anyone. I know so many of you out there are tuned in to the channel. You guys are dropping likes on the video, which are a great way to support the channel. You're getting the word out. You're sharing it with family and friend members. Because at the end of the day, the smart investors don't think about what they can make. They think about what they have and afford to lose in any investment. That is why Warren Buffett is as big of an investor as he is. I'm not even the biggest fan of Warren Buffett. But man, has he proven one thing, which is that he knows what he looks for. He knows when to buy into corrections and dips. And he's got a ton of cash right now. If you guys want to look at the, kind of large scale investors, they have tons of cash waiting on the sidelines. Many of the insiders of big technology companies that rallied over the last decade have been selling. Look no further than the insider selling track records, which are public data. It's public knowledge. They are taking advantage of the relief rallies here. They are absorbing that liquidity, which is helping the Fed with its job through these relief rallies. The liquidity traps are real. And this one has probably been one of the biggest during this bear market. So the question is, do you believe it's a bull market, or did you get caught in the Fed liquidity trap? It's not too late to go back into cash. Things really haven't dropped too much now, but the initial signs are starting to showcase themselves that things are about to get real. And if you guys aren't prepared to stomach that, I think it's time to start getting prepped as soon as possible. And if you guys want to be prepared throughout this bear market, I know you guys love watching videos on the channel. If you're this far into the content, I really appreciate it. But I just want to let you guys know there's not only a great way you can support the channel, but more importantly, that you can be better prepared here for these events. And that's through our newsletter here, the Dash Report. Now, I've got a link down below in the description. You guys can get 20% off. I think it's about 20% off if you sign up for the annual subscription. But this newsletter is a compact newsletter. It's about 20, 25 pages that I put out each month at the beginning of the month, where I talk about crypto, stocks, commodities, and Forex. We look at the whole macro perspective, depending on what's going on in the world and where the opportunity can be found. We give stock picks that we're talking about each month. During bull markets, when crypto was really raging hard, we look at different altcoin plays and also as well look for some opportunities to go long or short on crypto and different types of assets. There's so many different types of opportunities out there in the market, even in commodities as well, where we made a trade this month. But we're looking at a ton of potential short positions across equities here as the initial stages and signs are starting to showcase themselves of a further decline. So if you guys are interested, check out the link down below in the description. Again, if you guys are looking for that way to support the channel, that's one of the best ways you can do it. And it's a great community. We've got tons of community participants, some of the best, the cream of the crop when it comes to our community discussing in our discussion group. You guys will get trade alerts. You'll be able to join into our mid-month webinars, which I think we've got one coming up next week, where you guys can ask your questions. I'll go through and talk about the charts even more in depth than what we do here on the channel. So there's all kinds of stuff that you're going to get from it there. But until the next video, everyone, thank you all so much for giving me some time to ramble. If you guys, again, want to check it out, check out the link down below in the description. But until the next video, everyone, I will see you all in the next video. Take care, everyone.